Hi, I'm Jenny Ebert with Associated Bank. I'm here today to talk about down payment options. There is a handout that you'll be able to pull off of the website that can give you additional information. The first program that we're going to talk about today is our zero down payment programs, and I'm going to start out with the federal VA. The federal VA program is available for any honorably discharged veteran in the United States. It works for both regular veterans as well as National Guards and Reserves, and it is a true 0% down payment program. The funding fee is based on the type of veteran you are and the amount of down payment you have. Any veteran that is disabled and receives disability income either from the VA or from Social Security is exempted from paying the funding fee, which is kind of a nice advantage for those people. The seller can pay up to 4% of the sales price in closing costs for the buyer. The second program I want to talk about is called Guaranteed Rural Housing. It is also a government loan program. It is also a true 0% down payment program. Now this program is a little different. It's geographically limited to communities that are 12,500 people or less. So the city of Eau Claire and the city of Altoona are exempted from participating in the program. However, areas of rural Eau Claire and Altoona may be eligible, and there is a website that we use to check the address on that. As in 2012, the funding fee on this program is 2%, and just like the VA program, it's added to the loan amount, so it's not a cash outlay. And the monthly mortgage insurance on this program is 0.4%, which makes it much lower than other loan programs that are out there. The seller can pay up to 3% of the purchase price in the buyer's closing costs and prepaid expenses. Couple of things. This program does have income limitations, so we have to be aware of that. And the program is intended for residential properties, so if you have a larger acreage, any outbuildings, or any agricultural use of the property, that probably does not allow it to participate in this program. The next program that we're going to talk about is also a government loan program, and you're probably mostly familiar with it. It's an FHA loan. Now the FHA loan, the down payment that's required is 3.5%, but there is a lot of flexibility in where that 3.5% comes from. It can come from the borrower's savings, it can be a gift from family, some down payment assistance programs can be used on this program, and it can be a combination of all three of those. There is a maximum purchase price on FHA, and it's currently at $271,000. FHA also allows us to work with a lower credit score than other loan programs do, and the consequence of this is that the FHA mortgage insurance is more expensive. It's 1.75% upfront that's added into the loan, and then it's 1.25% on a monthly. One thing that's different about FHA is that the mortgage insurance year over year becomes successively less expensive. The seller, once again, can pay up to 3% of the purchase price in closing costs and prepaid expenses. This loan program is designed for properties that are in cities, okay? And it's very important that the property be located on a single lot that cannot be subdivided. If there's excess land, that can discount the property from participating in this program. Then we move on to conventional fixed rate loans, and that's what everybody is most familiar with. It is our standard old 15-year fixed rate, 30-year fixed rate programs, and there are several variables available for down payment. The lowest down payment is 3% in a program that's called My Community, that's sponsored by Fannie Mae. This program, though, your minimum credit score has to be above 700, so it's not ideal for everybody. The more standard down payment is a 5% down payment, and it does also require mortgage insurance. The mortgage insurance is based on income, credit score, down payment, and property type. So you may run into some properties that would require a larger down payment. You may also run into where the credit score is such that the mortgage insurance becomes more expensive. The mortgage insurance on this type of program stays at the same cost for 10 years and then goes down to a lower cost until you reach that 80% level. If you have a buyer who's looking for their second home, there's a few rules that you need to follow. The first rule is that the down payment needs to be 10% of the sales price. The second rule is that The second home must be at least 35 miles away from the primary residence. The property must be suitable for year-round use. It must have a well and septic, and it must have a permanent heating source. One thing we've run into quite often is second homes have like wall-mounted space heaters, and that is not an adequate source for heating, as well as no wood stoves without an electric baseboard backup. There are some unique properties that are out there that may require a larger down payment. If you have a buyer that's looking for investment properties, this is where the rules really start to change. For conventional fixed rate financing, the buyer is going to need either a 20% or a 25% down payment. The larger the down payment, the better the interest rate and the costs are going to be. There are some limits that you have to follow. As a general rule, Fannie Mae limits the number of rental properties with mortgages on them to 4. However, there are some exceptions where you can own up to 10 properties that are mortgaged, but there are some additional rules and cash reserves that are required in that situation. The hardest part for investors right now is that Fannie Mae and Freddie Mac require that you have 6 months of payment reserves for each property you own. So if you have $3,000 a month in mortgage payments, you need to have $18,000 in the bank in a checking or savings in addition to what you need for down payment. I do recommend that people check around with smaller banks and credit unions, because sometimes they may have in-house programs that would make exceptions to those rules. Some investors may find that commercial loans will suit their needs the best. And finally, we get to 20% down payments on owner-occupied dwellings. This is kind of the golden rule, and if you have 20% down, you no longer need to carry mortgage insurance. One thing I do want to note about mortgage insurance is that it is deductible to you on your federal income tax. That is a rule that's been around since 2007, and it was just renewed for the 2012 tax year. It's renewed annually by Congress. If you have a buyer with 20% down, they're typically not going to be looking for an FHA, VA, or guaranteed rural housing loan. A couple of notes: the 20% down payment can be totally gifted by a family member, and a large down payment can sometimes be compensation for a lower credit score. If you do have additional questions about different down payment options, I recommend that you give me a call. You can reach me at 715-831-3584 or check with your local lender. Thanks, and have a great day.